Hi, this is Nilus Mattive for Money Markets TV. One of my favorite strategies for the type of market conditions we're seeing now is covered call writing. In the case of an income portfolio, it works best when the market remains flat or pulls back a bit in the short term. And it can be an especially lucrative strategy when the markets are volatile. I think that's exactly the type of trading we're going to see over the next few months. To understand covered call writing, you need to know that call options are contracts that allow investors to buy a given security at a given price, which is known as a strike price, over a specified time frame. Each options contract covers 100 shares of the security, known as a round lot. Now, covered call writing means you're writing calls on stocks you already own. For the record, you can create and sell a call for a stock you don't own, which is known as naked writing. But I do not recommend the strategy because it leaves you exposed to a huge amount of risk. So let's suppose you write a covered call on 100 shares of stock you own. Once you sell that contract, the buyer pays you a premium, which is yours to keep no matter what happens next. Then, if the stock price fails to rise above the strike price of the contract, the buyer will let it expire worthless. You get to keep your stake in the company, any dividends you were paid, plus the money you collected for the option. The same is true if the stock goes nowhere or down during the life of the contract. And it's even true if the stock temporarily goes above the strike price, but the investor holding your option fails to exercise it. In that case, you can write a new call on the same shares and keep collecting premiums. However, if the stock rises above the strike price and the investor exercises the option before it expires, you're forced to sell your shares to the options holder at the strike price. In other words, the worst thing that can happen with covered call writing is that you'll be forced to part with your shares for the predetermined strike price, which means you lose any additional upside from that point on. But you can never be forced to sell for a lower price, and you can never suffer any downside risk, as long as you pick a strike price that's higher than your entry price plus commissions. In order to pursue this strategy in the real world, you have to get your brokerage account authorized to write options. But once you have level 1 options clearance, you can write covered calls, even in IRAs. Before jumping in, a couple words of advice. First, only write contracts that are out of the money, meaning choose strike prices that are higher than the underlying stock's current value, and certainly higher than the price you paid for the shares. Second, place limit orders. In other words, make sure to specify the lowest premium you're willing to accept for a given contract. And of course, don't sell the underlying shares until the contract expires or it's exercised. I'm going to be pursuing this strategy for my dad's income portfolio, and I think it's going to allow us to outperform the market once again in 2012. I'll be sure to keep you posted on how well the covered call writing works for us, and I encourage you to consider this approach for your own portfolio too. I'm Nilus Mattive for Money Markets TV. Thanks for watching.